All right, welcome. Today, we're diving into a really interesting puzzle, something inspired by the economic lectures of Michael Raviv. We're going to tackle a concept that honestly seems completely backwards at first, but it's an incredibly powerful tool in global economics. So let's jump right in. So here it is, the big question. We always hear about how important a strong dollar or a strong euro is, right? So, why in the world would a government want to make its own currency weaker? It just sounds wrong. To get our heads around this, we've got to start with the absolute basics. Okay, so before we can understand how a government can mess with a market on purpose, we first have to see how that market finds its own natural balance. And it all boils down to this one core idea: market equilibrium. You can kind of think of equilibrium as the market's happy place, or its sweet spot. It's that magic price where producers are willing to sell the exact same amount that consumers are willing to buy. It's the natural resting point for everything. And the best way to see this is with a simple graph.
So first up, let's talk about what we, the consumers, want. This is the demand curve, and it slopes downward, which makes total sense, right? When something is super expensive, fewer of us want to buy it. But as that price drops, demand shoots up. Pretty straightforward.
Okay, now let's flip the script and look at it from the producer side. This is the supply curve, and it slopes upward. And the logic here is just as easy to grasp. If you can sell your product for a higher price, well, you're going to be way more motivated to make more of it, right? So a higher price means a higher supply. And here's where the magic happens. That exact spot where the supply and demand curves intersect, that is our equilibrium. This point right here sets the stable price and the stable quantity for a product in its home market. But what happens when we throw open the doors and start trading with the rest of the world? This is where we start talking about exports, selling to the world. And believe me, this is where things get really, really interesting. Because all of a sudden, those local producers, they have access to a much, much bigger playground. Now, for a company to even think about exporting, there's one golden rule. The price they can get for their stuff on the international market has to be higher than what they can get at home. It just makes sense, right? If it is, then local companies have a massive incentive to start selling their products everywhere else. And that higher international price, it changes the whole game. Local producers see they can make more money, so what do? They ramp up production. That gives us a new higher quantity supplied, or QS. But at the same time, folks at home are now facing that same higher price, so they buy less. That creates a lower quantity demanded, or QD. So now you've got this gap, right? You've got a ton of stuff being produced, but a much smaller amount being bought locally. That difference is the surplus. And what do you do with a big old surplus? You export it. That gap you see on the graph is the country's total exports. Simple as that. All right, so now we've got all the pieces on the board. We get equilibrium, and we get the basic logic of exports. Now we can finally get back to our big question and talk about the government's secret weapon. And just as Michael Raviv lays it out in his work, this is where policy enters the picture. A government can actually step in and deliberately devalue its own currency. And what this does is it directly messes with that international price we were just talking about. It makes selling overseas even more attractive for the local companies. Okay, so take a look. This is our market before the government does anything. You can see that higher international price, and you see the gap it creates between what's supplied and what's demanded locally. That gap right there is the country's total exports. Now, keep your eye on the size of that gap. So here's the play-by-play. The government devalues the currency. What does that mean? Well, now every dollar or euro earned from selling stuff abroad is worth more when you convert it back to your home currency. So if you're a producer, it feels like the international price just got a huge shot in the arm. And on our graph, that means we're pushing that price line even higher. And just look at what happens. It's double whammy. That higher effective price makes producers want to supply even more stuff. But it also makes that same stuff even more expensive for people back home, so they buy even less. You see what's happening? Both of these things work together to make that export gap way, way bigger. We're talking more exports, which means more foreign cash flowing into the country. Boom! Okay, let's zoom out for a second and just recap what we've walked through. We started with a really simple idea in a single domestic market. And we ended up with this incredibly powerful tool that governments can use to shape their entire economy. So the whole chain of events is actually pretty clear now, right? It all starts when your international price is higher than your domestic one. The government then steps in and basically supercharges that price advantage by devaluing the currency. This makes local companies produce more for the world while folks at home buy less. And the big finish? A huge, significant increase in the country's exports.
So yeah, we've seen how this whole devaluation thing can be a massive win for a country's producers and exporters. But here's the thing about economics. There's no free lunch. Every policy has a trade-off. And that leads us to one final, really important question. If goods become more expensive at home because of this policy, who's actually paying that price? Who feels the pinch? That's definitely something to chew on.